Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. I am super excited for today's show. David Pitts, welcome to the show. How are you today?
I'm great. Thank you.
Great. All right. So before we get to David, and David's going to start by giving us some background and kind of telling us who he is. But before we get to David, one of the reasons why I asked David to be on the show was because ever since the pandemic hit, one of the biggest requests that I get is, Mish, I want to give up my green card. I want to give up my U.S. citizenship. It's a process of what we call dealing with the U.S. exit tax. And when that occurs, the exit tax rules are not super straightforward. They're not well defined. We're currently on our third version of the U.S. exit tax. The current rules that we have were put out in 2008. And those rules then came with one tax notice. It's called Notice 2009-85. We'll put a link to that in the show notes. But what didn't happen, what normally is supposed to happen, is that Congress writes an Internal Revenue Code, and then the IRS is supposed to then put out what are called proposed regulations. And the proposed regulations then tell us how they interpret the Internal Revenue Code. And those are open to the public. Anyone can comment on those. A lot of practitioners tend to comment on those. And then there's notice. So that's notice. And then there's a hearing. The IRS then listens to people talk about the proposed regulations. And then, sometime later, they do final regulations. Now, there's also a set of regulations for the succession tax, which is Internal Revenue Code 2801, that accompanies that were actually done. But those also, I think, need to be kind of done under the same process, and were not. That's recently been contested in a court case called the Arresti case, which is super interesting because in that case, the court basically said the exit tax had no teeth. It was basically invalid because notice in the hearing was never done for regulations. So this is an area where it's developing. We're once again, we're so many years down the line. It's 2024. The IRS promised to put out regulations in 2009. And it's an area that's developing. We could see new regulations and all this stuff very soon. Alternatively, you could see Congress even come out with a new exit tax next year when they're talking about whether or not they're going to carry TCJA forward or not. So it's a hot area. It's a new area. I do a lot of work with David in this area, and I thought it would be great to have him come on and give his kind of insight and background to the audience. So sorry for that long kind of diatribe on the exit tax and kind of setting the table, but I think context is important in this situation. David, tell us about yourself. Tell us your education, your background, where you're licensed to practice, all that good stuff.
Sure. Thanks for the introduction. I grew up just outside of Hartford, Connecticut, and that's meaningful because that's for a great bit of time. Hartford, Connecticut was the kind of the headquarters of insurance companies in the United States. And because there were insurance companies, there were a number of actuaries running around. And I had always been good at mathematics. I went to Tufts University and got a degree in mathematics. Wasn't quite sure what I wanted to do with myself. And then I started taking actuarial exams right after I graduated. The year I took the first exam, the Jobs Rating Almanac came out and said that the actuarial profession was the best profession in the world in terms of stress and job prospects, so on and so forth.
I see. So not accounting. So accountants are not the best. It's actuarial back there.
Well, there's a lot of interplay between accountants and actuaries for sure. And okay. I often say I didn't have the personality to be an accountant, but that's
I would disagree with that, but keep going.
Okay. At the time, you could kind of pick a major. Do you want to be an insurance company actuary, or do you want to be a consulting actuary. And at the time, pension plans were going like gangbusters, rational exuberance. A lot of pension plans were well overfunded. So much so that had companies safed up their investments, they might have been able to pay for their pensions in perpetuity without
Wow.
putting in another nickel. Back to the yeah, like I said, the late '80s. So much so that there was a movie, Wall Street, I believe it was called. It was Michael Douglas, and the whole premise of the movie was companies, predatory firms would take over companies and just dismantle them immediately, terminate the pension plan, and recapture the surplus.
Wow.
Congress, they changed the laws on that, and unfortunately, things have kind of gone a little bit sideways for quite some time for pension plans, and there's been a bit of a long, slow, steady decline from the '90s. And so I find myself nowadays as an independent practitioner, a solo practitioner, and I do a lot of valuation work. So it could be for divorce settlements, it could be for exit taxes, it could be for personal injury lawsuits, could be ERISA class action lawsuits. I tend to do a lot in that area, and so that's kind of my background. Love the profession, continue to stay involved. I do a lot of research. I've written research articles, and I help with the education committee for the Society of Actuaries and try to help my fellow actuaries moving along.
That's great. And do you see a lot of actuaries going into insurance actuarial still, or consulting, or where's the profession kind of headed to now?
Well, there's a great question. There's a lot of actuaries are involved in healthcare. A
Okay.
lot of actuaries continue to be involved in insurance. The traditional pension sector for actuaries, the role has changed a bit. We
Hmm.
continue to have a lot of cities and towns, government plans. We continue to have a lot of union plans. The private sector, there's been a bit of a shift in that a lot of companies are doing what was known as de-risking. They're trying to take the pension plan down a notch or two in size, and they will typically slough off a big chunk of their liabilities and run off to an insurance company like a Prudential. And
Okay.
that's a really interesting movement. And one of the things that's happening is that a lot of the big insurance company will have a lot of what we call mortality exposure. And mortality exposure would mean people die too quickly. So if you have a block of life insurance policies, if people die too quickly, think about COVID, then that's bad for the insurance company. However, if people die too quickly, that's actually good for an annuity business, right? So annuities are subject to longevity risk. People live too long, whereas
I
life
see.
insurance is subject to mortality risk. People die too soon. So by combining those two risk exposures, a lot of insurance companies feel that they've kind of mitigated some of the risk and they've hedged their bets, so to speak. So there's some real value
Gotcha.
doing that.
Wow, that sounds like an entire podcast episode on itself that we could get into. Um, I
That's
want
right.
to get into the good stuff, though. I want to get into the U.S. exit tax because that's the purpose of this. I also want to kind of get some more meat and potatoes on retirement plans and pension plans. But before I do that, one last question about actuaries. So my son's 8 years old; he's in second grade, and parents are now starting to come in and like do these. Here's what I do. Here's my profession. And my wife suggested that I go in and talk to them, and my son said, "That sounds like it'd be very boring, Daddy." Uh, I had to agree with him. I said, yeah, I don't think your second grader's going to see have any fun when I come in and talk to them about taxes. But pretend like I'm an 8-year-old, and they were to ask you, David, what's an actuary? What is it? What does an actuary do? Like what is your job if you were telling that to an 8-year-old?
I predict the future.
Okay,
I think that's probably a good way of saying it. The future is uncertain. There's a
okay,
lot of different things that can happen, and people like me uh, use a lot of data, analytics, statistics, computer modeling, and we try to identify a range of possible outcomes. And so one thing you could think about is, let's say, a casino, right? Where if somebody's setting the odds for how much the roulette wheel pays out, or what the different slot machines pay out, actuarial science is something that could be used to help define the distribution of outcomes. Now, a casino is a little bit of uh, an arbitrary world, because with a roulette wheel, assuming it's perfectly balanced, it's kind of a well-known distribution of outcomes ahead of time. For
Okay.
us, if I'm trying to predict how long somebody's going to live, I don't have perfect foresight. I have a lot of data points I can use, and we have a lot of projections we can make about the future. For example, back in the 30s, the 20s and 30s, a lot of children died, and right around childbirth. Uh, and we've since taken care of a lot of those problems in the medical field. And because of that, we can then adjust what we think life expectancies may mean going forward, in that we can reduce things like childhood mortality, uh,
I see.
women giving birth, that sort of thing.
Great. Great. Okay. Let's get into then what the main topic is. That was a great answer. Thank you for that. Let's talk about the exit tax. And just from a quick overview, tell us your thoughts on the exit tax. I know that you kind of maybe want to walk through a little bit about the Internal Revenue Code of the exit tax, which is 877 Cap A, the notice that I talked about, the 2009-85. And then I think there's some terms that are specifically in your world, which I know a lot of, when I tell them to people, their eyes kind of gloss over, like, what do you mean net present value? I don't know.
Right,
What does
right,
that even
right.
mean? Yeah. So give us the high points on some of those things I know that you wanted to talk about.
Sure. Thanks. And first, before I answer, I do want to say that um, it's not uncommon for actuaries to work very closely with tax professionals like Mishkin. My area of expertise is not in the tax laws themselves, but it's more in the what we call the actuarial valuation. So if I'm an insurance company and I want to price how much an annuity costs, I can do that. But if I want to talk about different statuses as a highly compensated employee, and in and out, and adjustments that one needs to make to the taxes, that's where I work closely with Michigan, and I don't pretend to be an expert in that area. So as you said, there is not a lot, the, because of the lack of regulations and that sort of deviation in the normal regulatory process. We don't have a well-defined set of instructions. And that's not to say we don't have instructions, because we have tons of instructions. And there's the IRS notice that you mentioned, which purports to give a lot more details about how uh, to apply the provisions of the exit tax. There's the exit tax itself, the statute, and then buried within the IRS notice that describes how to implement the exit tax. There could be references to yet other sets of regulations, revenue procedures, other parts of the Internal Revenue Code that get brought to bear for the calculations. So um, again, there's guidance, but it's not necessarily authoritative. It could be, my perspective is that we can use it, but we're not bound to use the guidance that's out there. Sort of a good faith compliance look at the world.
That would be correct.
Okay, good. Good. And I do want to say, so my understanding is one of the big things that has to happen for either a U.S. resident who's giving up their residency, or a green card holder who's relinquishing their green card status. There's this thing called an exit tax. It's kind of like a toll on the way outside the country. And uh, the way you calculate well, one of the things that needs to be calculated is something called the net worth test. And there's a threshold. It's kind of like an on-off switch. I believe it's $2 million still. That may be subject to change going forward, but right now, 2 million is kind of the magic number. And the exit tax describes how to value all the various assets that comprise that $2 million number. And there's a whole section that gets carved out for deferred compensation plans. And you know, like I said, nothing is trivial, right? Things are complicated. And deferred compensation plans could be a savings plan. That's an obvious example. Something like a 401k. So deferred compensation is exactly what it sounds like. It's compensation, so it's earnings that get paid later and in a deferred fashion. Um, so within the realm of deferred compensation plans, we have your savings plans, which are like 401k plans. We have stock option plans. Those are not terribly common. And most common, and most of the work I do with Mishkin is for pensions, defined benefit pensions. Uh, a perfect example would be if I'm a World Bank employee and I am looking to relinquish my green card. One of the items that gets calculated for purposes of the exit tax is this gross present value of the pension, of the World Bank pension. And then that gets put into the machine that Mishkin looks at for all the different assets.
Correct. And so, David, why are you just looking at why would an actuary look at a defined benefit plan and not a defined contribution plan? Is there not any analysis needed for a defined contribution plan under the exit tax
Sure,
rules?
sure, sure. Yeah, that's great. So those were the three main categories.
Mhm.
And so the next question is, well, how do I put a price tag on these three main classes of deferred compensation plans? And
Okay.
a savings plan is pretty trivial in that I usually can get an account balance by the minute. I look up my account. I've got a Fidelity account, or I've got a cash balance account, which gets valued, and I can access an employee portal to tell me how much that value is. So that tends to be trivial, right? It gets a little bit more complicated when we talk about the net present value, which we'll talk about in a moment. But for savings plans, again, it's the account balance typically. If I'm looking at a stock option plan, there is value to stock options, but uh, it's probabilistic, right? So in order to come up with a value for a stock option plan, I would need to use some sort of Monte Carlo simulation or a Black-Scholes closed form formula. There's different techniques out there to price options, right? And then the defined benefit plan is unique as a unique animal in that the promise is typically to give the retiree a certain amount of money per month as long as they live. As long as I'm alive, I get a monthly check. Oftentimes, if I pass away, then I have a beneficiary that might get the same amount as me, or maybe half of what I was collecting. So there's this notion of again, a probabilistic set of outcomes. I need to use my crystal ball. I need to predict what the actuarial present value would be for a pension. And
Right.
it's kind of a confusing item, but I would say it's the fair value. And if one were to say, well, what is your best guess, Dave Pitts, about how much this pension is worth? I'll come up with a number and it'll be precise to the dollar, but half the time I'm going to be too low relative to how long a person lives and actually what they collect, and half the time I'll be too high in terms of what I'm predicting. But it is in fact the fair value of the distribution of possible outcomes, and that's what we're instructed to look at when we do the exit tax calculations.
Okay, so let me pause there for a second and recap and kind of set some table for the audience a little bit here too, so they can understand. So there's kind of a two-part process to the U.S. exit tax. There's this first three-part test, and two of the three tests have nothing to do with David. That's my world, right? So we're looking at the 5-year average income tax liability, which that's not super straightforward in itself, because a lot of people will tell me, well, Mish, I made more than $200,000 a year, so I'm going to fail that test, and I'm going to have to remind them it's your income tax liability, not your taxable income or your gross income or anything like that. And it's it's a very special place on the 1040 that you have to look at, because it doesn't consider credits and a lot of other stuff, or it does consider credits of certain types. So that one is more of what I do. Then there's a 5-year audit or compliance test, which you got to make sure all your tax returns are kind of in order and your international tax filings are in order. Again, that's what accountants do in our world. And then what David is referring to, the first part, the first hurdle, that the first solve that I'm asking for David is, I need a value to put for a defined benefit plan. Okay. In my world, a defined benefit plan has no ascertainable value because it's a moving target. A lot of times the clients have not started receiving their income stream, or maybe they have, but it's only a certain amount that they get per year. And I'm like, I can't tell whether what number I should use there, but I'm trying to calculate their net worth, because that's one of the three tests. Like David said, it's a $2 million number. I would argue that that's a really low number that comes from 2009. Obviously, we've had tremendous change since 2009, not to mention, as we're all probably feeling, tremendous inflation. I would say that number probably should be more like a $7 to $10 million, maybe even higher. I don't know. But and that's something that if they do come out with proposed regulations, I would be the first one to opine upon. But the first solve for David is, what's the number that goes in there? And I think, David, you said that in your world, that's the gross present value. And I'm going to ask you how you calculate it. I remember you maybe even talked about that a little bit, but how do you specifically get into that? And then the second part is, okay, depending on those three tests, if you fail one of those, and certainly I've seen people fail each and every one of those tests, then that's when the exit tax actually kicks in. So it's kind of like a threshold. Like, you have to fail one of those three. And then if you fail it and there's no way to get around it, then the exit tax kicks in. And then the question is, well, what's my exit tax? And people are always saying, well, what's the rate? What's my tax? And there's not one set tax. It's a misnomer. Like, oh, the exit tax is this. It's a combination of different types of taxes that can apply depending on the different types of assets that you have. They can generate different types of income. And then the second question I have for David is, what number do I use to calculate the tax due on the pension? And we'll get into kind of that as well. But I just want to make sure everyone understands kind of where we're going at here, and that we're still right now on that seminal question: are you a covered expatriate subject to the U.S. exit tax, or are you a non-covered expatriate? And the determination of that, for what we're talking about with David, is the net worth. And then within that, we're looking specifically, more likely than not, at defined benefit plans for which we do not have an ascertainable value. It's not something we can define as accountants. So now I got to bring in David. All right, David, let's get back to you. Let's talk a little bit more about that. Tell me a little bit more about the gross present value, kind of how you do your work around that. Give me some more details on that.
Yeah, sure. So first and foremost, we need to know, well, how much is the individual actually receiving? And if you're a retiree, it's pretty well defined. You know exactly how much you're getting every month. There's some uncertainty in that too, because oftentimes there's a cost of living adjustment factor that's built in. So we
Okay.
don't know what inflation is going to be in the future. And so typically we make some sort of assumption for that. But if you think about it, if I'm 65 years old and I'm collecting my pension, I mean, I could live maybe another 40, 45 years. Not very likely, but there's a slight probability I can live that long. And so it's a
Does
long, kind
it
of a
does it
medium to long term projection, I would say. Yeah. I'm
okay.
sorry.
Does it change your analysis if someone comes to you and says, David, I work out 7 times, I'm 65 years old, I work out 7 days a week, I take all these supplements, I believe in functional health, I have a walking pad, I walk 12,000 steps a day, I want to live to be 130 years old. Do you factor any of those
Yeah.
comments in, or do you just kind of ignore that and
Typically,
use kind of
typically not.
standard?
Yeah. Typically not. Again, it's a pretty big distribution of possible outcomes that can
Okay,
happen, right? In any one year, you might only have a 2 or 3% chance of dying in that one particular year. So you can almost
okay,
think about, again, going back to my roulette wheel, instead of, the numbers, it could be the ages of death. And when you spin it, you can change the size of the slices on the wheel. But again, we don't really know exactly when you're going to die. Um, the One of the analogies that I heard that I liked is, if I'm in a room full of 1,000 people, I can say, well, I'm not going to tell you who's going to die, but I can tell you how many, right? So
are gonna
again,
die.
it's a
Yeah.
probabilistic look. There are large data sets that track things. So, for example, one of the most common would be just looking at the population, right? When COVID hit, we had a spike of excess deaths. So, if you were simply to look at the population weighted age of death, you would think life expectancy went down, and that's true. The observed life expectancy went down, but all the insurance companies, they never changed their predictions about the future. In fact, some of them even think that people are going to live even longer today, post COVID. Theory being that, well, we got rid of a lot of the dry tinder. It's a little bit harsh to say
Mm.
that, but
Okay.
with the RNA technology, maybe we're quicker to fix diseases going forward, that sort of thing. So again, it's kind of a law of large numbers phenomenon. It's very difficult to look at any one individual and say, well, you're going to live 5 years or 8 years or 35 years, that sort of thing. Having said that, we do know that there are a few key drivers that influence an awful lot of outcomes. One would be
Okay.
male versus female. Females live longer. That's pretty well known. Another one would be smoking versus non-smoking. There's a life expectancy differential for people that smoke, and the third one would be self-reported. Do I consider myself below average health compared to my peers, or average health compared to my peers, or above average health compared to my peers? Um, so those things can be done. They tend to be a little bit more speculative than simply looking at data for a large population. So some of the things that I look at current mortality tables. The Society of Actuaries releases mortality updates every single year for the pensioner population. Looks at all, hundreds of thousands of covered pension lives, and you can get uh, one mortality rate from looking at that section of the population. Uh, Similarly, one could look at the entire U.S. population. Now, a lot of people would suggest that that's really not appropriate for a retiree, because baked into those numbers would be, let's say, some homeless people, people that are disabled, they don't work. So you have kind of a different rating class if you're a retiree. If you're fairly well off, you tend to have better life expectancy as well. So we can play around with some of those things. I tend to try to help folks. So in your example, Michigan, I would not try to be make an argument that this person's going to live a lot longer than his peers, because that would increase the actuarial present value, thereby increasing the exit
Yeah,
tax. And in a
I see.
world
Okay.
where we don't really know, we're not required. Again, the rules are kind of not well defined. I can't really see an argument for doing something like that in this situation. Similarly, there's an IRS set of actuarial tables for taxation of life insurance and remainder trusts, and it comes into play with a lot of taxation for life insurance type policies. So
Right.
that's
And
your
if you look at
mortality
the
question. Again,
yeah,
I'm
if you
sorry. Go
look
ahead.
at the yeah, if you look at the notice 2009-85, and I think you mentioned this earlier, it's like a little spider web. It then points you on a lot of those mortality things to the estate tax, the gift and estate tax rules, and kind of those. it's kind of like
Right.
leading you into other things. It's not really giving, like you said, it's not direct guidance or authoritative guidance. It's just saying, hey, well, we have a suggestion. If you want an answer to this question, maybe look over here, look over there, and then we'll rely on those rules have nothing to do with the exit tax, but we're going to say that that's where our intersection comes with other areas of the Internal Revenue Code. And again, I'm that's not something that I think it's a really bad way of kind of enforcing the law or giving guidance on the law, because it opens up a lot of additional questions and doesn't give a lot of good examples, even though the Notice 2009 does give some good examples. So
Right.
I just want to make sure that that's clear to a lot of people, that that's kind of where you're pulling some of your stuff from.
Right. Right. And unlike financial reporting, for example, where there's kind of a fair value construct. In that situation, we wouldn't be looking at actuarial tables that were 10 years old, published by the IRS for estate tax purposes. But taxation is a different animal from financial reporting. And so I think there's a good logic for taking a look at the estate tax rules as well, or
Okay.
guidance. The
Got
other
it.
key, and
Okay.
this is quite important too. One more quick thing, Mishkin. So mortality tables are a big piece of the puzzle, and the other big piece of the puzzle are interest rates. And what
Okay.
people often say that a pension is kind of bond-like. So it's a series of predictable payments with an uncertain payout. We don't know exactly how long it's going to continue, but we do know roughly speaking, what the payment structure looks like. And that's very much like a bond, and people price bonds all the time in the financial markets. Suffice to say that there is a relationship between the interest rates and the actuarial present value, much like there's an interplay between interest rates and, let's say, a mortgage payment, right? As the interest rates go down, I can afford to buy a bigger house for the same amount of money each month, and it kind of works in parallel. If the interest rates go down for the same amount of pension each month, my present value goes up. So right now, as interest rates are starting to creep up a little bit, or they're coming down, anyway, it's interest rate sensitive is the point I'm trying to make, and
Okay.
that's another moving piece of the puzzle. We look at interest
Okay.
rates as well.
Yeah. And you have to factor that into whatever you come out with. Okay. Anything else in the gross present value before we move on to the actuarial present value? Or
No, I think
B, you want
that
to go
does
into
it.
the covered
Yeah.
expatriate stuff, or
Yeah, actually, one last thought. The actuarial valuation calculation is tried and true. Actuaries have been doing this calculation for probably 100 years at least. It's something we do, and it's pretty routine. Uh, Knowing what the proper assumptions are, of course, is where the expertise comes in. But a lot of times people might think, oh, I can just go look up the actuarial present value on the internet. And you could, but you don't know what's driving that particular calculation. Is it the CDC tables? Is it the population mortality? Is it Social Security? Is it the tax laws? So those numbers can vary quite a bit depending upon which source you look at.
yeah, and my personal opinion, I mean, certainly you could go to Chat GPT, you could go to a wide variety of places to do that. But from my world, I think that because that is a number you're plugging in to two very consequential items of tax, I still think that you got to get an actuary to come in to do both. If you have both calculations apply, do both calculations. I think it's mandatory, especially because this is the last bite at the apple that the IRS has. Once you submit this information to them, they are going to look at it. It does go to a very specialized unit of the IRS in Austin, Texas. They are going to look at it. And if you give them something that they raise their eyebrow on because they see a lot of this stuff, then and they come back and challenge it, that could be bad news bears, because you could wind up being, maybe you thought you were a non-covered expatriate, now you're a covered expatriate. So you got to be very careful with how you're presenting that information.
Right.
Let's get into the covered expatriate stuff
Yeah.
and
And
the
the end
second
result
calculation.
of what I do.
Yeah.
Yeah. Okay. So right. So once we have the big number, I call it the big number, the gross present value. In my world,
Okay.
my simple the way I understand this is, and when you're looking at the net worth, I'm counting all the money in the mattress and the bank accounts and the right everything, right? The gross present value of my pension. Now, oftentimes, particularly with World Bank pension plan, a lot of people uh, pay for their pension in addition to the company paying for the pension, and they pay
Hmm.
for it with an after-tax contribution. And in the spirit of not taxing people twice, if you've already taxed somebody once on monies going to fund their retirement, they shouldn't be taxed again in the net present value. So one of the key carve outs that we look at is from the gross. How do we implement the offset for taxes already paid, right? And look at
Right. Your tax.
1099Rs. Sometimes there's schedules that come into play. So that's one big adjustment that gets made. The other big adjustment that gets made is the law provides for a foreign service exclusion. So let's say you've got a bunch of years working for, I don't know, I keep using World Bank. Let's say you're in Mexico and then you move to the United States, you get a green card. And so when I calculate the gross present value, the big number, I'm including all the years of service that you earned pensions while you were in Mexico. But when you actually come to paying taxes, you weren't a green card holder at that time. You were services performed outside the U.S., so we can carve that number out. And even that can get a little bit complicated, right? There are multiple ways of trying to carve that foreign service out. A typical way would be to look at a service proration. I work 10 years in Mexico and 20 years in the US. Well, I can reduce my gross present value by 10/30ths, right, for all that service. Sometimes it's worth it to take a look at what did I actually earn? Because maybe when I was in Mexico, I didn't really, or maybe, well, maybe I made a lot of money in Mexico and I didn't make as much in the United States. And so if I prorate based on service, I'm
Not
overpaying
enough.
versus what I
Yeah.
actually accrued. So we look at those things as well.
And what David is talking about is very common with a lot of international organization employees, not just the World Bank, the IMF, which we refer to David a lot of our international organization clients, but UN. A lot. What happens is you have a lot of non-U.S. people that are maybe they're working for that organization in a foreign country. They're on assignment there for a period of time, could be a long period of time. Then they take an assignment inside the United States, or maybe they're in the United States starting off with that international organization, then they take an assignment outside the United States. And so again, these are little things that have to be considered when doing these calculations for the second part, which is the includable part if you're a covered expatriate. Another situation I see is you have someone that maybe is a non-U.S. person, maybe a C-level employee that is then coming inbound into the U.S. They got their green card. They were then in the U.S. for 10 years, maybe 12 years into the green card, but then they want to give up the green card and go back to their home country. So they've got a bunch of service from the home organization and a foreign country for their pension that then could be potentially excluded. And what David is talking about is there's a way to whittle that down a little bit. That's a special election, though. I'll warn people that's a special election you have to make, and you have to make it overtly when you're doing your tax filings. So David does his part, but on top of that, you kind of have to say, well, look, we're making this election, and that's the way the notice reads. You got to make sure you're notifying the IRS that you are making that election to exclude that foreign service. And any other items that you want to talk about related to
And
the net present? Yeah.
yeah, I do want to circle back to the savings plan example you gave, or we were talking about earlier. Trivially, it's the account balance when we're looking at the kind of the gross present value for the net worth test. If you have to parse out the different pieces of your savings plan based on where you were at the time, that's where things can get a little bit more complicated. And I do that as well, right? So sometimes we have to look at the actual cash flows and the investment earnings for fixed periods of time and have to parse the value up in that fashion.
Okay,
And
great.
the last thing I
And
would say is that when I finish my piece of the puzzle for Michigan, I produce an actuarial certification. I cite all of the different standards of practice that I use. I'm very um, precise in terms of the communication so that if in fact an audit does occur or during a routine review, you've got a certification from an actuary in your file. And so you've done the best you could in terms of trying to comply with the exit tax.
and you do that certification even if it's not a pension. So, for example, if I came to you with stock options that I couldn't value for the exit tax, or something else that's floating around, you would be able to do a certification for that as well.
I would. I would, yes.
Okay,
It's not
great,
as
awesome.
critically, well, yes, but the answer is yes. I would certify that as an actuary that's familiar with these sorts of calculations. It's not truly actuarial in nature, like using like Monte Carlo simulation, but it's tangential and related enough that I think that the actuarial certification would go a long way toward you know confirming and validating the numbers.
Okay, perfect. And so, David, tell us about what does it look like to work with you? Like if I need your services, let's just say someone comes and talks to me and says, "Hey, yeah, I get it. I need to use an actuary." What's it going to look like when they reach out to you? How does the process go? Do they have to sign a contract? What's it like to work with you?
Thank you. Great question. The and we've done a fair amount of the handoff where Michigan will just make an introduction, a soft introduction. I typically will provide. I've got an actuarial reference manual for those of your listeners that want to dig deep into the weeds. They can do so, and it describes everything I do. Most people don't want to do that. And so there's a few very basic questions. One would be, well, tell me about your history in terms of your green card service. When did you, uh, or your residency? Where were you? How long? Over what time periods? When do you think that you're going to be exiting the country? Right? Because we need to have a measurement date. The measurement date. A lot of the work we're doing now is for 12/31/2024. A lot of people are thinking they're going to let their green cards lapse at the end of this year. So it'll be a little bit of a projection in the future. Um, the second piece would be the basics in terms of the pension. How much are you collecting? What's the currency? Do you have cost of living adjustments? Do you have uh, a joint and survivor coverage? If you do, what's the date of birth of your beneficiary? I tend to do some limited underwriting. So if you're a smoker or if you're below average in terms of your life expectancy or your health status compared to your peers, I can make some adjustments downward to the mortality tables for those. Um, and I tend to be collaborative. Uh, and these plans really are all over the maps. There's nothing standardized about one pension plan versus another. So it's not it's kind of everything is a custom made suit. We don't do the stuff off the rack. We have to look at all the individual details. Sometimes getting tax information can be complicated. Sometimes we have to kind of backfill certain missing numbers. So the process again would be an initial conversation. My fees are pretty modest. Tend to be about on average maybe about $1,000, depending upon the number of plans and the complexity of the calculations. And once we kind of go back and forth, and we work collaboratively and we come up with the final report, then I hand it back over to Mishkin and his group.
That's right. And by the way, I love that analogy of the tailored made suit, because that you couldn't have hit the bullseye better on that one. We see that all the time. People, oh, but it's very similar to this other plan. It's like, no, 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 no. They're all written very differently. They all have a different kind of
They
take
are.
on it, and that's, I think, where having data is super helpful. I love working with David. We've worked with David for quite some time. He does fantastic work for a lot of our clients. In fact, in my engagement letters for consulting for exit tax planning, I always indicate, if you've got certain types of pensions, we're not putting a value on that or values for the two different parts that are needed. You got to get an actuary involved. I don't force anyone to use David, but I always recommend that people do use him. And the work product that we get back is super helpful for having us make our decisions, or helping the client make their decisions, us giving the advice, the client making the decision on, kind of, okay, this is your net worth. This is, now you're a covered expat. You've got this net present value inclusion amount, which, oh, by the way, is taxed at ordinary income tax rates. This is your estimated exit tax due. What do you want to do? How do you want to deal with this? And that gets into where, we can really help them out as far as strategy and how they want to deal with that. So it's a very powerful thing that, goes a long way with providing clarity and helping the client get the data points they need to make a good and smart decision. And I would strongly encourage anyone that's doing or considering doing an exit and that has potential pensions that need to be looked at by an actuary to get an actuary involved. And I think, David, you made a great case for that. My final question to you, David, if there are new regulations and or Congress comes out and gives us a new exit tax, will you come back on the show and kind of give us your thoughts on what's new and what's floating around out there and what to think about?
Absolutely. And, just piggybacking off that, it is a pretty specialized area. The actuarial present value calculation itself is fairly routine, but, we're dealing with German pension plans, Japanese plans, international banks. It's really all over the map. I've had to have Japanese interpreters sometimes in the work that I do. I've had German interpreters, Spanish interpreters. So it is, there's a lot to it. And I tend to learn something every time I pick one of these up, and I feel like I should know it all by now, but there is a lot to it.
Yeah, same here. Absolutely. And you're definitely right. It can involve a lot of different moving parts and a lot of different helping hands. So definitely not something that's an easy exercise. Well, David, thank you so much for being on the podcast today. I always learn something new when we talk. I hope the audience has taken away 2 or 3 good nuggets of information, especially if they're considering doing an exit or want to understand a little bit more about how the craziness of the U.S. exit tax works. And with that, we'll say goodbye to everybody.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.